Okay. No. All right. So good morning, everybody. Thanks for taking time out of your days to come listen to what I have to say. I'm going to try to keep today's topic as interesting as possible. It's not a very interesting topic, mortgage guidelines, but I feel it's important that realtors have enough information just to be dangerous at the very least, and truly to know what's really available. Because I think one of the biggest problems in our industry is that half of the loan officers don't even know what they're talking about. So how can we expect the realtors to know, right? So I've got a little presentation put together that I'll share with you guys. And again, I'll try to keep this as easy and enjoyable as possible without getting too far into the weeds. All right, let's turn this into a presentation. Okay, everybody see that? Lending overlays. That's what today's topic is about. Mortgage guidelines, lending overlays. I while I was building this presentation, I was really trying to think, how to put this into layman's terms for you to understand and how to really make it beneficial for you. And so I kind of got away from the idea of lending overlays and guidelines, and I really just kind of want to give you a synopsis of how the mortgage industry works, and how important it is that you have a well diversified portfolio of lenders at your disposal. So, a little bit about me. If you've been on any of my presentations before, you've seen this slide, but I feel it's important for you to know who's talking and why you might be worth listening to. So I've been in the business for 20 plus years now. I've worked in all different models: big banks, call centers, retail shops. I'm currently co-own a brokerage with my best buddy at 20 years, uh, Apex Home Mortgage. But I have been a big fancy suit for some of the big lenders, and I have been a call center scrub. So I have seen it all. About 5 years ago, I left the big corporate world. My buddy and I started Apex Home Mortgage. And I threw all the corporate stiff suit stuff out the window and just started being my authentic self, and my business has blossomed as a result. And I think there's value in that lesson that it took me, 15 plus years to learn. So anyway, that's who I am, 100% by referral, and my client retention is over 80%. If you think about the fact that I exist in a world where, my own father is going to go with a different lender if he has a better rate than me, an 80% client retention rate is huge. And that's really the value that I try to bring to my realtors as well, is that 80% retention rate is passed on to the realtors I work with and partner. Too long didn't read. Okay. Make sure you're using a trusted professional as your mortgage advisor, preferably one who's a broker and has access to multiple investors and lender programs. Also, make sure every decline gets a second opinion. Okay. If you have to log off right now, that is the gist of what we're going to be talking about today. Okay. And we'll get into the weeds a little bit about how and why. And if at any point anyone has any questions, just chime in. Okay. This is real boring if I just talk for the next 45 minutes or whatever. It'll be a lot better if you guys are interacting and if you have questions about anything. All right. So again, I'll try to keep this as entertaining as possible. But in this country, there are essentially two different ways to get a mortgage. Fannie, Freddie, and Ginnie Mae are the government-sponsored entities that 80% of the mortgages in this country go through. Okay. Now, here's the reality. A lot of people don't realize this. Every loan that you get from a bank or a mortgage company is it's not the bank's money. It's these government-sponsored entities' money that they're loaning out. Okay, so they have to meet certain guidelines that these entities have put in place. If they meet them, they present it to these entities. Those entities will purchase that money from them. Okay, now no bank would make a mortgage from their own money when they could just sell Fannie Mae's money. That's the first thing that everyone has to understand. Why would you give someone $400,000 for a house when you could just get Fannie Mae's money for the house and still make all the money as the middleman intermediary? Okay. So Fannie Freddie are publicly owned corporations. They are under government conservatorship since the crisis, which means that the government stays on top of them, makes sure that they're behaving properly. There's also, they're purchasing all the mortgages in the country. And so they can't say, we don't want to buy mortgages anymore. They don't get to say that. That's their job, is to purchase the mortgages. So Ginnie Mae covers USDA FA. Guys, 90% of the loans that your clients will ever get are one of these two, either a Fannie or one of these two. The second one's coming, but this is the first one, the government sponsored entities. Okay. The second way you can get a mortgage is through all of these loans that don't fit into that government sponsored entity box. So this includes jumbo. Some of you might have heard of non-QM, home equity, reverse mortgages, portfolio loans, hard money. Okay. What this means is that a jumbo loan, for example, the Fannie and Freddie have only said that we'll purchase a loan up to 750. And that's the limit here in Maricopa County. So if a lender wants to make a loan for $1 million, they're on their own. Fannie and Freddie aren't going to come in and purchase that. So that lender now has no guarantee, no safety net for that loan. They're taking on all the risk. And that's why jumbo is just a completely different animal. The rest of these loan programs all fall into these categories. Okay. These are not overseen by Fannie and Freddie. Portfolio loans, if you've got a bunch of money and the bank looks at you and says, yeah, you don't have any income, but you got a ton of money and you got a ton of money invested with us, we'll give you that loan. Like, these are outside of the guidelines of where 90% of the mortgages that you and your clients are going to run into. But these are available to you. And so part of the point of this presentation is for you to understand that not all of your lenders have these secondary products available. And so if your client doesn't fit into this square hole, if they're a round peg, most lenders simply don't have options for them. Now, these are the two different places you can go to get money. Okay. And again, 90% of the loans are these first ones, because why would you loan your own money when you can get paid to loan the government's? Right? That's the attitude every bank has adopted. So what are overlays? That's what this presentation is supposed to really be about. Okay. Overlays are restrictions that individual lenders may or may not place on top of the pre-existing guidelines to add an additional layer of protection or risk management to their portfolios. Okay. So for example, capping a borrower's allowable debt ratio at 40%, when guidelines say you can get a debt ratio as high as 56% on certain products. Okay. This is where I feel it is so important for realtors to know just enough to be dangerous, because the reality is, to this day, the borrower typically finds the realtor first. You guys are selling the sexy, fun product. My product's boring. It's full of numbers and math and obligation. It lasts for 30 years. I'm no fun. You guys are the fun ones. You're the ones they seek out. Now, if you, as an agent, don't have a reliable vendor in your tool belt, you may be missing out on a ton of opportunities. And so for example, I'll get into this in a little later here as we get further down the presentation. But so many loan officers that work at these bigger companies and these bigger corporations, they don't have the knowledge or understanding to even know that their company has put these overlays on top of the guidelines. Okay. So for example, at Chase, okay, and not to disparage, I bank at Chase. It's a great bank. I worked there for 8 years. I like Chase. Okay. I would not, as a realtor, send my buyers to Chase, right? Just as an example, if you walk into Chase, when I worked there, at least, this might not be true today. Okay. And I'm not trying to pick on Chase, any bank, any company. Chase will not loan unless you have a 700 credit score, conventional loan. Again, this might not be true today, so don't go calling Chase and then tell me I'm a liar. But when I worked there, You needed a 700 score to get a conventional loan. So imagine the reality is you only need a 620 credit score to get a conventional loan. So imagine all the people that have thought, you know what, honey, we want to buy a house. Well, gosh, we bank at Chase. That seems like the logical place to go and talk to them about buying a house. So they walk into the Chase bank, they get their credit pulled, and the loan officer who works at Chase, who isn't really a loan officer, might be. There's some good ones there, but he looks at him and says, "Hey, I'm so sorry. Your credit score is 660. You got to have a 700 credit score to buy a house. Here are some things that you can do to fix your credit. Apply for this Trace credit card. Go talk to our financial advisor about, they're selling you other stuff. Sorry, we can't, there's no mention that, hey, you can buy a house, you just can't buy one here. Unfortunately, we have these overlays. But if you just walk down the street and talk to that guy, you'll be in your house this weekend. Those people literally left that meeting thinking to themselves, we can't buy a house and we're 50 points away. We're just going to have to sign another 12-month lease. And so the only way to stop this, because again, the loan officer, doesn't know that that's an overlay. He just thinks that you need a 700 credit score to buy a house. He thinks that's the rule, right? So think about all the people that have been told something like that in one form or another. And as you, as the realtor, when they're coming to you first, it's your responsibility to protect them, take care of them. Yeah. And listen, if you got a super clean borrower, they're putting a bunch of money down, they want to go to Chase Bank, Chase give them a good rate, like it's okay, right? I'm just saying that you as the realtor need to be aware of the differences between the lenders that you might be working with. Now, before you'll see the 5 C's of underwriting. This is something that I taught to loan officers, new hires. This is something that I think anyone in this business needs to understand, the 5 C's of underwriting. This is what underwriters are looking at on each and every file. Okay. Those 5 C's are capital. How much cash do you have? Credit. What's your credit scores? Capacity. This refers to income and debt ratios. Collateral, the property being pledged, and then the characteristics that are unique to that home. For instance, they're buying an investment property, or maybe they're buying a second home or something like that. So I'm going to go through each of these 5 characteristics and help you identify where lenders have overlays in place and where your borrowers might be getting bad information, and where I feel it's important for you to know, hey, that's not necessarily valid. Maybe we should go talk to someone else, right? Because a lot of people will show up, oh, we already have a lender in place. It's my cousin's brother, whatever. And, that guy might be 2 weeks in the business, doesn't really know what he's doing. There are 2 types of ways to get a loan through underwriting. Okay. And when we're talking about these conventional and Fannie Mae and Freddie Mac and FHA and VA loans, they're going through the automated underwriting system. There is a software that every lender uses, and you fill your application out and you send that loan through the automated underwriting system. It's going to check all the different qualifiers and it's going to spit out approved or denied, right? Approved but ineligible. So that means that they meet the guidelines, but maybe they don't have enough cash to close. So if we just get enough cash, now they're approved and eligible. Now, anytime we're talking outside of that box of conventional loans, understand that jumbo loans, these non-QM loans, home equity loans, all of those are done through a manual underwrite. You have an actual person looking at the W-2s, looking at the pay stubs, and making decisions. Now, what a lot of lenders out there won't do are what are called manual underwrites, because again, they're selling Fannie Mae and Freddie Mac's paper. And if they just have to run it through the automated system, the software, and it does all the work for them. But a manual underwrite requires a physical person to look at the file and do all those calculations themselves. A lot of mortgage companies don't want that added risk or that added expense. And so a manual underwrite is just not in the cards. And so there's major companies that do this, like name brand companies that everybody knows, where they won't manually underwrite a loan. And so a manual underwriting, like maybe their debt ratios is too high, but we have other qualifying factors, other compensating factors. Maybe there's some income that we're not even using. Maybe there's a spouse with income that we're not using. And these compensating factors can allow you to overcome some of these objections. And so what you need to know as a realtor is, hey, has your loan been, have you gotten an automated approval? Yes. They said yes, great. If they say no, or I've had trouble getting approved or whatever, just know that this manual underwrite is an option, but you have to have a lender that will do it. A lender that said, hey, this is worth the added expense to capture this business. This is a business of convenience. Like they just have to push buttons and everything works, right? We got to get an underwriter to actually dig into this file. It's a little different. Now, don't get me wrong. Underwriters are looking at every file, but they're just following Fannie's guidelines. They're not using their brains, or they're just, can we check this box? Can we check that box? Can we check that box? Manual underwrite affords your buyers a lot more flexibility. All right, we're going to talk about these different characteristics of a loan and common overlays that you need to look out for. Okay, so the first one's capital, your down payment. What you need to know: lenders want to ensure that you have enough for your down payment, any closing costs, and any required reserves. Now, reserves equal 1 month of your total obligations. So if you have a $2,000 mortgage payment, a $5,000 or a $500 car payment, and $500 worth of credit card bills, you have a $3,000 monthly reserve. Well, lenders don't want to take every last dime you have, right? Now, I can get them approved with every last dime you have being involved in the transaction, but it's not just down payment. It's down payment, it's closing costs, it's reserves. Okay. So minimum down payments, you guys should know this if you don't already, but 3.5% for FHA. First time homebuyers on conventional is 3%, and 5% for any other non-first time homebuyer program. 0% for VA, 0% for USDA. If you're buying a second home, you need 10%. If you're buying an investment property, you need at least 20%. Okay. Now, you're not going to see too many overlays around this. But one I have seen is lenders who won't allow you to buy a house without a 5% down payment on a conventional loan, even though there is a 3% first time homebuyer program available. Lenders have just said, we're not comfortable with 3%, we want 5. So that's their rule. And every loan that's ever been done through that bank had to have 5%, even though they could have got 3% if they would have just gone somewhere else. Okay. So this is important to know. I mean, that's $500,000 house, 2% is 10 grand. It's a lot of money. So credit, we talked about how the banks might have a higher threshold for credit scores. Okay. And I think that's the most common one. So you guys need to know that to get a conventional loan, you have to have a 620 credit score. That's it. Okay. If your score is higher than that, an FHA loan might still be better, because the reality with a conventional loan is if you don't have good credit, good to excellent credit, FHA is probably a better option, just because the conventional pricing gets a little crazy if you don't have good credit, right? But know that you only need a 620 credit score with a conventional loan. And as far as FHA, VA go, you only need a 580 credit score, okay? If your credit score is below 620, you need a 10% down. I'm sorry, below 580, you need a 10% down payment. It's the only thing that changes. But I can get a loan, and I have gotten loans for people with a 520 credit score. They needed to have 10% down. That same person was told that they needed to have a 700 credit score at their bank. Okay. This is that's a buyer that the bank just let walk away. Right. So does that mean we're going to get everyone with a 540 score approved? Of course not. But this particular person had a ton of down payment money, and we were able to get it done because we ran it through the automated underwriting system and it says approve eligible. And that's something important I forgot to mention here. If I run it through the AUS and it says approve eligible, that means it's approve eligible. And that means that Fannie and Freddie will buy that loan. And so any any restrictions that the lender has placed on it don't exist at a different lender. So capacity. Okay, so I'm sorry, back to credit. Just know that you can buy a house with 580 credit score with no money down through VA. You can get a loan with the minimum down payment with a 580 credit score through FHA. Okay, so many places have put 640, 620, 660, 680, especially through COVID. We saw that where lenders are putting overlays on top of the guidelines. We know Fannie and Freddie are cool to 620. We want a 680. And again, the problem is that the loan officers that work at these companies are typically of less quality, and they just don't know, nor do they have the motivation or care to say, hey, I can't help you. Go talk to this person because they can. There's someone else right behind that person. They're just showing up to work. So, okay, capacity. I also want to mention that every client I talk to, my conversation is the same. We have things that we say, right? And so I run every client through a 3-step hurdle. We want to buy our first house. We're not sure where to start. Okay, cool. I'm going to run you through 3 quick hurdles. Okay. And if you pass these 3 hurdles, then we'll dig in deeper. Those first 3 hurdles that I'm running them through are capital, credit, and capacity. So the first thing I ask them is, how much money do you have to put down? That's the first question because it determines where I go from there. Because if they don't have any money to put down, then their pool of available loans is very small. But if they have 20% or more to put down, I've got a lot of options for them. And now I know that maybe even if their income is non-traditional, maybe they're self-employed and aren't showing income, like I still have a way to get this done because I know they have a big down payment. So that's the first question that I'm asking them, is to understand how much it's going to open everything up for them is their down payment. And the second one is their credit scores. I want to make sure that they're going to qualify for these basic programs. Those first 2 hurdles are really quick. One simple question, simple answer. Capacity is where it gets a little crazier. And this is where we're digging into, what kind of income do they have? How much of their income are they being able to use? If I had $1 for every self-employed borrower that told me they made $200,000 a year, which is in reality is true, but their tax returns show they made 40, I'd be a rich man. So wanting to make sure that they're going to meet these guidelines in regards to the capacity. Okay. So again, I don't want to get too much into the weeds here, bore you guys with a bunch of statistics. Okay. But just know that Fannie and Freddie want your debt to income to be below 45%. Okay. But we can get approvals at 50% all day, 49.9% all day. Now, certain companies might have restrictions saying, in order to get a loan from us, your debt to income ratio must be below 45%. Again, that's fine. But guys, on a $500,000 house, okay, if your payment is, say, $3,000, that 10% of your income, if that gap of that allowable ratio of 5% on a $500,000 house, we're talking about like $100,000 in house. So in other words, at this bank that won't allow a DTI over 45, the most they qualify for is 400,000. But at this company that doesn't have lending overlays, they qualify for 500,000. It's a huge gap. And so, there's no way for you to know, hey, what's your lender's DTI cap? Like, point is not for you to be asking these questions. The point is for you to know that this is available and that you really need to make sure that your borrowers are getting hooked up with the right lenders. FHA can go up to 56% DTI. Not a lot of people know that. VA, I've seen VAs with a debt ratio as high as 70% get approval. I mean, it's crazy. And at a place where they won't allow debt ratios over 45, I mean, this guy's a home buyer all day, but he talked to two people, and those two people had lending overlays, and he's renting. So, but you want to watch out for these DTI restrictions. You also want to look at, miscalculations. These aren't things that you should be looking at. These are things that I'm looking at, right? But so, for example, I had a perfect example of how this can affect you today, this morning. We have a client who's buying a new house, and he's converting his existing house into a rental property. Okay. Now, lending guidelines state that all I need to wash that payment on his departing house is a lease agreement. That's what guidelines state. However, lenders have overlays that say we want a lease agreement and proof of first month's rent, proof of first month's deposit. Well, in this scenario, this buyer was being told that, and he doesn't have it. He can't get it, and the timing of the scenario is going to screw everything up. But the reality is that I have lenders all day that will take that without the proof of the security deposit, because the guidelines only state that you need a signed lease agreement. But again, these banks and companies are saying, that's cool that Fannie wants that, but we would feel a little bit better if we also had this. So give us that. So if you're talking to someone else, that's not a problem. That was just this morning. So restrictions around rental income, restrictions around retirement income, asset dissipation. If you've got borrowers that might, maybe they're on Social Security, but they've got $300,000 in a retirement account. The average loan officer working at these companies just says, "Oh, you only make $1,200 in Social Security. I can't help you." Well, he could have turned that $300,000 into another $1,500 in monthly income if he knew what he was doing, if he knew that lending guidelines allowed that. Oh, his lender company he works at doesn't allow asset dissipation. So that person just can't buy a house. They can buy a house. They're not talking to the right person. So non-allowance of certain income types, restrictions around paying off debt to qualify. I do this all the time. Okay. You guys should remember this. Okay. So many times I see people that have $800, $1,000 car payments. Okay. Oh, fine. Everybody wants a nice car. That's cool. But what they don't understand is someone will come to me and they'll be like, "Hey, we want to put, 50 grand down on this house." Okay, cool. Oh gosh, you don't qualify because you have an $1,100 car payment. I tell you what, I want you to put the minimum down on this house, 5%. And I want you to take all that money that you were going to put against the house, and I want you to just pay off your car. Why the hell would I do that? It's a 6% loan. It's only a 5-year loan, da, 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 da. And the reality is because that $1,100 payment is the equivalent of $400,000 in house. Meaning that if you didn't have that car payment, you could afford that much more house. Now, well, my payment's way higher. Okay, your payment's $500 higher than you wanted it to be, but you just got rid of your $1,100 car payment. So your total outbound expenses are now $500 less total, even though your mortgage payment is $500 more than you wanted it to be. Now, this is an easy way to fix this problem, but certain lenders might say, "Oh no, you can't pay off debt to qualify. That's cheating." We're going to put an overlay that restricts that. Okay. Collateral, property being pledged. Okay. You're not going to see a lot of overlays on this one either, but the most common ones are manufactured homes, condos, right? A lot of lenders won't do manufactured homes, period. Guys, Fannie, Freddie, FHA, VA, they love manufactured homes. The lenders don't. So any lender that says we don't do manufactured homes, that is a choice that they've made as a company. We don't want to lend to manufactured homes. The reality is, once again, you just need to find a lender that just sells directly to Fannie and Freddie without any of the concern, right? Condos is another big one. But I think probably the one that's most practical for you guys is delays on loan amounts. So for example, this year, 2023, the max conventional loan amount is $726,200. Now, on January 1st, 2024, that limit goes up to 750. But here's what everyone's missing. The new loan amounts were announced in September. And I and many others, I'm not special. I am special, but there's many others that can do it. I've been writing $750,000 conventional loans since September 1st when it was announced. Most lenders, when it's announced, they delay it until it goes into effect on January 1st. So I've had 3 months of the new guidelines, the new loan amount, even though it doesn't go into effect until January. And the reason for that is because the lenders that I'm sending these loans to are just simply going to sit on it until January 1st. And then they'll sell it to Fannie and Freddie. This is a like easy solution. But so many lenders out there will say, nope, January 1st is when it goes into effect. So if you're like, I just saved a client $27,000 of down payment. Do you think that he's like telling his friends and family about me when every other lender he talked to said you can't borrow more than 726? Oh, dude, I could do 750 right now. They just announced it 2 weeks ago. Delays on new loan limits is probably the biggest one here in regards to collateral. Characteristics, okay? All loans need to meet these two requirements. They need to meet the guidelines and they need to make sense. Okay. Now, as long as they do that, the lender can't deny the loan outside of overlays, right? So common thing that you'll see is, underwriters just not following the guidelines to a T. Maybe they're asking for a little bit more. Over conditioning of files. For example, here's a great example. Lending guidelines want 1 year W-2s and your most recent pay stub. If you are employed, that's it. Okay. Now, some companies will say, we want 2 years W-2s, or we want 2 years tax returns. And maybe that second year kills your deal. Well, the reality is you can get a deal, even if you just need 1 year of income documentation. But if this company wants 2, and that second year income is dramatically less, that could really affect your borrower. And so, another thing, like you see these program restrictions. How many of you know that you can buy a home for your elderly parent and you could buy the house next door to yours and you could do it with a minimum down payment of 5% and have it treated like a primary residence? That is a Fannie Mae guideline. It's called the Fannie Family Opportunity Program. You can buy a house for your elderly parent and do so as a primary residence, and that house can be right next door to yours. But so many lenders just don't participate in that program. Oh no, yeah, we've heard about it, but we just don't do it. Same thing for the doctor loan. Doctor loan. All the doctor loan is it allows the lender to use the borrower's education to solve the 2-year employment gap. I mean, that's all it is. And Fannie will let you do it, but so many lenders are like, well, we don't do the doctor program. So just needs to meet guidelines and it needs to make sense to the underwriter. Another common thing that we see with people working remotely is making sure that it makes sense. If you live in Mesa and you have to go to work every single day, but you're buying a home in Sholo and telling me that it's going to be a primary residence, that doesn't make sense. But if you can provide a letter that says, hey, this guy can work remote, he doesn't have to come into the office, now it makes perfect sense. So characteristics. So many loan officers are just paper pushers. They don't know what they're doing. They're just doing what they, the lack of the training in our industry is not good. And, I've been doing this a long time and I'm embarrassed, but so many people just don't know what they're talking about.
Okay,
So,
good time, my love. Tell her I.
all right, gang. Again, I think the too long didn't read is just go local. It doesn't have to be me. I'd love it for it to be me, but I'm not everybody's cup of tea. But just make sure that you're working with someone who, as a broker, I have access to all these different lenders. So I've got 20 or 30 different lenders that I use for my Fannie, Freddie, FHA, VA stuff, right? And I know, oh, this one has overlays, this one doesn't. I have one lender, my best priced lender. Their rates are fantastic, but they won't do a loan unless you have at least 10% down. Again, you only need 5% or 3% if you're a first timer, but they just say, we want 10%. So when I'm talking to a client, how much do you have for a down payment? We only have 3%. Boom, that lender's out, even though they've got the best rates. Right. And so just knowing this stuff is so important for you and your clients. You want to be able to refer your client. Hey, that's great that you got your pre-approval from Chase Bank. They're great. I bank there too. That's awesome. To tell Johnny down at the bank I said hi. But I want you to talk to someone else that's not a bank, that's actually a mortgage company that just specializes in mortgages, because as the realtor, you just need to know that that piece of this transaction is okay. You need the confidence to know that if I come back and tell you, hey, this isn't going to fly, like it's not going to fly. Like it's not, if someone gets told something and like they just had to talk to somebody else. Just had another guy who was trying to buy a house with his VA entitlement, and this lender just butchered this thing. This guy already owns a house and he already has a VA loan, and this idiot told him that he could buy a new house with the VA and not put any money down. They're under contract, and we get back the VA entitlement, and it shows that he's got an active VA loan, and he had a short sale, so all his VA entitlement is gone. He needs to put $200,000 down through VA to buy this house. The lender, oh gosh, I apologized to him. I screwed it up. So sorry. Sent him on his way. So the first thing he comes to me is like, hey, VA. So and this is when I found out, dude, you're not even eligible for VA. You should have never even been going down this path. But the thing that blew my mind is that this guy qualified for a conventional loan. So all that loan officer had to do was say, gosh, I'm so sorry I screwed this up on VA, but good thing is we got a conventional loan and you just need to put 5% down. Like he could have kept this deal together. But instead, he just told the guy, I screwed up your VA. Sorry, dude. Like, good luck. So I don't want that to happen to you. I don't want it to happen to anybody. And the only way that I can ensure that doesn't happen is by begging you to send him here. Make sure that doesn't happen. We're more efficient. We have more options. I know who has overlays, who doesn't. I know who offers the DSCR loan on an investment property. I know which lenders will take the family opportunity program. All these. I know which lenders have DTI restrictions. So that's my presentation. There's my contact information. I would love to be able to help any and all of you, your clients. And again, don't let any denial walk without getting a second opinion. And that second opinion should absolutely 100% come from a broker. Okay. Brokers can work with everybody. I don't work for these banks. And that's why I tell these people, I spent my whole career working for banks. I felt dirty. I had to go home every day, take a shower. I felt, I could see what was happening and how these people are getting ripped off by these big, huge corporations. And that is why we started Apex, and it's a brokerage. It's about options. It's about choice. It's about guideline adherence. I can't, like, it drives me crazy when a lender tells me they're not going to do it. And I say, here are the guidelines. Here are the guidelines. Yeah, we don't care. Like, just make sure you're working with someone who is accountable to your clients. I don't work for these banks. I work for your buyers. I don't get paid by the bank whether or not they're like, I get paid when the loan closes. I work for them. I don't work for these banks. I don't answer to these banks. And that's all brokers. So it's super important that you guys are working with the right lenders. All right, I've spent a bunch of time talking. Does anybody have questions?
Hey, Greg, this is Stacy Kusaba.
Hey, Stacy.
Hey, this was a great presentation. Thank you for all of the info. I really learned a lot. And
Awesome.
I wanted to know from you, is there any way for us to find out about the overlays that certain lenders are using in advance?
No,
Okay, so
there's
it's
really,
all learning.
yeah, because here's the problem is that it's a living document. Next Tuesday they might announce this. And then 3 Fridays from now, they're repealing this overlay, right? Hey guys, we'll now take loans with a DTI up to 45%, where it was previously capped at 43 and now it's 45, but it's still 50. So I would say that if they're working with a major bank, a depository bank, you probably want to get them away from there. Some of these bigger mortgage companies, it's really a lot of like the Fairways and the Nova Home Loans of the world. They have they're usually pretty good about not a lot of overlays. Um, but where they're getting your clients is in the pricing. You know, um, the reality is that the mortgage. By the way, guys, the last 2 days have been phenomenal for rates. We've gotten. I mean, we had 80 bips of improvement today, which is significant. We're probably in the low sevens right now, as where we were in the mid to high sevens, last week. So anybody that you do have on the shelf, just reach out to them. Say, hey, I heard rates came down. Have you talked to your lender? Now's a good time. This weekend would be a great time to get a place. But there really isn't any way to know. It's really just about the company. You don't want them working with, you know, call center employees. You don't want them working with people that don't really care. Like people that there's someone right behind you. So, like when I worked at a call center, like I didn't care if I had to decline this guy because there was another call right after that. And even like maybe I could have approved this guy, but it would have been a little extra work. Gosh, there's probably an easier one right behind this one. Just keep them away from places like that. You know, um, I'm a real person. I don't work for a company. I don't wear a suit. You guys are lucky I put a collared shirt on just for this presentation. But and I think that is the appeal. Like when people talk to me, they feel like they're talking to a real person. They're not talking to some company where they're like, I'm not sure if we could tell Greg, this or not. Like we're gonna borrow some money from our parents for the down payment. Should we tell them that? Like, it's I'm vested in them. I have an interest in their success. We build relationships. You can't be 100% by referral if you're just, you know, wham bam, thank you, ma'am kind of transactions. We're really holding people's hands, making them feel special, making them, educating them,
Right. That sounds
empowering
great.
them.
Because correct me if I'm wrong, but it sounds like you are going to work with people and let them know their options.
Yeah.
And that's what I like hearing.
I don't sell
Appreciate
anything,
your answer to that question.
Yeah. I am a salesperson, but I don't sell. I educate and I like, hey, here are all your options. Sometimes to the point like of my detriment where I've given them too many options and now they're confused. But that's where I feel is how you're going to help people best is just educating them and letting them know. For example, that trick of paying off the car. Like you literally pay off, take the money you were going to put on the down payment, pay off your car. Your total outbound cash flow is improved by $600 a month. If you take that $600 a month that you saved and just apply it towards the mortgage because you're already paying it anyway, now your mortgage is paid off in 18 years instead of 30. And I'm saying, and your car's paid off. Like you're not going to get this from some Chase loan officer or some Rocket mortgage 800 number loan officer who doesn't care. If they can't fit you square peg into that square hole, they're on to the next one.
Can I just piggyback of what she was asking about, like how do you spot the overlays? What I do, and it tends to work out, is if people are talking to me and they're telling me like, oh, the lender, like if it just sounds like they're asking for like way too much stuff, and they want like their firstborn child's like birth certificate and stuff,
Yeah.
if it sounds ridiculous, then talk to somebody else. Like I had people come into an open house and they're like, well, we were told we can't buy a house till we're citizens. And that's not true.
Not
And
true
I'm
at
like, that,
all.
well, I'm like, that's weird that somebody told you that. And so we had a whole conversation on that. And once they talked to somebody else, it was like, oh yeah, you can totally buy a home. It doesn't
Right.
matter, like there are certain visas that are acceptable and everything. So if something seems off to me, or if it just sounds like this lender's asking for way too much, that's when like a red flag rises with me. And I say, you know what, would you be open to talking with somebody else?
Yeah.
Because I don't think that that's true.
Yeah.
So just from a realtor standpoint, that, there's just certain red flags, I guess, that
Yeah.
just, if it seems ridiculous, it probably is.
Yeah. I mean, and honestly, like without sounding, obvious, but like the agents that I've worked with for a long time, that I have, really solid partnerships with, like they're at a point in our relationship where like they wouldn't even dream of letting someone use someone other than me, right? Like it's to the point where, oh, it's great that you have your own lender, but I really please just talk to my guy, right? And I'm at the point now where like, hey, I just want to talk. Like I'm not necessarily trying to steal the deal or anything, but I just want to make sure that your approval's good. You know, um, getting a second opinion, encouraging your people to just get a second opinion. If they're showing up with financing, red flags, just the name of the company. One of the biggest ones is for veterans. And I tell everybody, if the name of the company has veteran in the name of the company, run. Get your client away from that company ASAP. This includes the Veterans United of the world, Veterans Equity, even like USAA. USAA is a great company. I will not disparage them at all, but they're an insurance company. If your veteran is trying to get a loan from USAA, tons and tons of overlays, no urgency. It's going to be a miserable process. No accountability from the loan officer. Again, USAA is a good company. They're not a mortgage company. They're an insurance company. So as a realtor, I wouldn't want my client getting a VA loan through USAA or Veterans United or any of these places. The other ones, it's more about the fact that they're ripping them off. With USAA, it's not their business model. So, just being aware of these different kinds of companies, right? That horror story I just told about the VA guy, I mean, that was a Nova loan officer, which horrifies me because Nova is supposed to be one of the good companies, and that it's not saying anything negative about Nova. It's just one guy, but those are things that we should know, and for the guy to just be told, sorry, you can't buy a house. I screwed up. I miscalculated your VA eligibility and didn't even look like, well, let's look at conventional. I feel sorry for any realtor relying on that person to get a deal to the finish line. So, and that's, again, there's so many of them out there. Don't get me wrong. There's a lot of great loan officers. There's loan officers that are 10 times better than me. But, I'm unique in that I don't have a team. I'm the one talking to every client. I've had a team and I didn't like it because we would start to miss stuff like this. Dude, Johnny, you didn't ask him if he already had a VA loan when you told him he was, oh, dude, like that was in your training. Like, I can't deal with that. So I don't have a team. It's me. I have two processors. They're on a round robin. So every transaction you'll only be dealing with two people, me and one of these two girls. And I'm involved, so again, I'm rambling at this point. I don't even remember the question. Sorry.
I have a question, Greg. That was a great presentation. I really enjoyed that.
Thank you.
I'm not clear on who's setting the standards. Is it the Freddie Mac and Fannie Mae that is saying we're only gonna loan up to 750? Is that where these standards are coming from that you're getting the overlays on, or the banks are?
Yeah, so Fannie and Freddie, and together with the Department of Housing, are setting these guidelines and these limits.
Okay,
And then it's so basically they just say, hey, here's our rules, come get our money,
gotcha.
right?
Yeah,
And so lenders they do that, but there are some lenders that say, that seems a little risky for us. We're going to put this overlay on top of that guideline. And
gotcha.
again, these overlays, it's a living body. It changes. You know, during COVID, everyone had overlays. Fannie didn't change their guidelines, but COVID, all the lenders were like, whoa, we want a 700 credit score. We want a letter from your employer stating that you're not going to get laid off. Like those were lender overlays. So
And
the guidelines are all encompassing.
right.
So you just have to find a lender that doesn't have an overlay.
So the motivation for the lenders to have the overlay, I mean, what is their concern?
It's just an added layer of protection.
For them, in case.
So here's most lenders that service their loans will have overlays.
Okay,
If they're keeping the loan after it's been originated and you're going to make your payment to Chase or to Rocket Mortgage or whatever, then they're more inclined to put overlays on it because they're the ones that have to collect the payment.
gotcha.
If
That
they're
makes
just
sense.
planning on selling it, it's someone else's problem.
Right.
We just need to make sure that we've met the guidelines.
Perfect. All right. Makes sense. Thank you.
Yep. Anybody else? Cool. Well, there's some faces on here that I haven't met, so I'd love the opportunity to meet with you guys. I'm going to be reaching out via email, just sending all my contact information. And if anybody would like to schedule, 15, 20 minutes to just sit down and chat, and I'd love to help. I think one of the easiest things we could do is any realtor that doesn't have a Google business page needs to get one started ASAP. I've been focusing on that for, probably about 2 years now. And I'm excited to say that I'm getting business just off of raw Google searches for the first time. And I
Nice.
haven't done anything special other than create the page and then make sure that I'm directing my clients to the page, not only for reviews, but just to go look at it. Because every time someone clicks on it, it's going to push it higher in the search. So if you go online, at least in where I'm sitting, and I just search mortgage broker, like I'm in the top 5. And again, like I'm not paying for anything. I'm not doing anything. So this is one way that I can help you just real quick with a quick phone call, helping you get a Google business page set up and driving clients there for reviews. But being 100% by referral, having an 80% retention rate. I want you guys to know that, when I educate my clients, I empower them. This endears them to me. My clients love me because they never felt sold. They never felt like they had anything shoved down their throat. They just felt like they had a friend looking out for them. And that's why they come back to me and they send me their kids and their friends and their family. And I know that is my strong suit. And I know that it is not every realtor's strong suit. And so just know that if we're working together and your follow-up isn't great and your systems for keeping in touch isn't great, mine are. And I'm friends with those people. And they come back to me. And the first thing that I say to them is, have you talked to your realtor? No, they didn't keep in touch with me. Well, if I haven't talked to you either in a long time, well, guess who that lead's going to? Right? One of my realtors. If we're still working together, then it's going right back to you. So just taking care of people, I have a vested interest in their success. I might talk in a slow month, I might talk to 10 people in a month. I need to get 2 or 3 of them to the finish line. So everybody gets all my attention. And that's the business model we've created. It's hyper local, hyper individual. They'll never talk to anybody but me or my processor. So, and I could do a lot more if I were willing to let go and hire a bunch of people and take on all the responsibility and let the quality of the interactions go down, which I'm not. I tried it. I didn't like it. I'm cool right here. So would love to chat with you guys about how I can help. I don't do, I'm not the best at like, here's a flyer or here's the new and latest gimmick that we're pushing to like. The reality is they're all gimmicks. The 2-1 buy downs, all this stuff. Yes, it is something that is a tool in our tool belt that we could use, but is it what's best for the client? Not always. So I don't lead with gimmicks. I don't even have social media at this point. It's just about taking care of people, educating them, and relying on them to send referrals back to me. And that's the other thing is that, in order to get referrals, you have to. There's a system. Like the first time I talked to him was like, hey, I just want you to know I work by referral. I'm so happy that you were sent here. Just so you know, my goal is to take such good care of you that you send me referrals too. Like I'm saying that within the first 30 seconds of talking to them. And so I'm just teaching them. And every time I'm checking in on them, like, hey, we've done a great job. Like you're already approved. We're going to close a week early. Are you excited? Hey, do you have anybody that you can refer? You said that you would, right? You said that you would, if I took great care of you, you'd send me all your friends and family. Like we're closing a week early. Guys, you'd be amazed how many people be like, yeah, actually my brother, why don't you call him? But if you don't ask and you don't set that expectation, because it's one thing to be like, hey, please send me your referrals. Okay, will do. It's another thing to be like, hey, remember what I did for you? Remember that you told me that you would send me a referral? Right? Like, I've done what I said I was going to do. Right? Just a different way to approach it, but it works. Doesn't work every time, but it works. So this is what you get. Okay. This is what your clients will get. Just real talk, a real person. I don't sugarcoat stuff. I don't pull punches. I just tell them what's real. I don't tell them what they want to hear. And I build relationships with them. And I've become friends with a lot of them. But my favorite part about my job. Yes, Wendy.
Oh, I gotta go. I got another meeting,
Okay.
but thank you so much.
Yeah, thank you. Oh, we're definitely running up on it. Yeah, thanks guys for coming. I'll send emails out to everyone and happy to help any way I can. All right.
Awesome. Thanks, Greg.
Thank you.
Great, thank you.